Hello, Keith Prather here with the RV demand index update for this month. Let me go ahead and share my screen. Okay. So this month, the RV demand index is giving us a couple different signals. So they're 1.2% higher month over month through March and was also 6.1% higher year over year. So we saw a decent surge in demand kind of coming into March and into the first quarter, headed into the busy travel season, if you will. And this would signal, look, we're back up to the long-term trend line, which is great. And then we also are at its highest level since really going back to about where we were coming out of the peak in the pandemic, right? Well, we couldn't go out, we couldn't travel, we couldn't be in a lot of public, but we could go RVing, and you saw that surge in demand. We're now kind of getting back up to levels that would rival maybe where we were prior to the pandemic, even. So that's an interesting signal that the demand index is giving us. And again, typically these will look about 6 months ahead. So it's signaling to us that there's a pretty good demand environment coming forward. So let's hope that continues. Even the sales index was 0.7% higher month over month, and then 6.5% higher year over year. So even though not back up at the long-term trend, the amount of sales that we've seen up to date currently still look pretty good. So we've got both a forward-looking index that looks like it's going to be very strong, and then the current index, which also looks like pretty stable, and it looks like there's some pretty decent activity going on here. I've talked about this in a lot of the other sectors or reports, and I wanted to cover it here a little bit in the RV sector. But then we're going to hit some other specific items that I think are really driving the industry, and I think will continue to drive the industry over the next year. So this is our model for retail trade. And what we were doing is we went and we looked at it prior to the April 2nd tariff risk. And you can see the retail sector here really growing and showing some good, strong growth through the end of the year, spilling over into 2026 before it even softens just a little bit. But then we went in and we looked at the impact of the April 2nd reciprocal tariff announcements, and we looked at what it was doing to economic data. So we looked at stock market impacts, consumer sentiment, corporate sentiment. We looked at a lot of things, how it was moving the bond market, so many different factors that go into these models. And we looked at and we modeled all those inputs. We put those all into the formulas, and what you see is just a little bit of softening here. So we were running right at $67 billion a month in retail spending. It looks like it eased just a little bit down to about 65 billion at its peak, but this is not a recessionary signal. So a little bit of deceleration, but even with the tariff risk at some of its highest levels, the models are not picking up any kind of a recession signal at all. This would be diving like this if the models felt like tariffs were going to have a significant impact overall. So it's giving us a pretty good signal as we go into the second half of the year, which is great. But there's a couple other things I think that could be catalysts for the RV industry. So I didn't have it in the actual document here, but we talked about it many times. Remember the great wealth transfer that we talked about? And there are still many baby boomers that, unfortunately are kind of hitting that stage in life where some are passing away, they're passing on their wealth to the children, and they grew some of the greatest wealth accumulation in the history of the United States. And so you have some younger generations now, between the ages of 25 all the way up to 55, 60, that are suddenly getting several $1 million in wealth dropped in their lap. And with that, a lot of them are taking early retirement. A lot of them are trying to figure out what they want to do with their lives. But one of the things that they're obviously doing is they're going RVing, and they're going in, they're upgrading current models. They're buying brand new ones. Some are just getting into it for the first time. Some are, as we said, kind of taking major leaps into the type of RVing that they're doing. And so that's one catalyst. But the other catalysts that are happening, more near term, is that we think the Federal Reserve is going to step in June. So for short-term borrowing, if they do step in and do their next quarter point cut in June, that should help spur sales. And then we think there'll be at least two more between now and the end of the year. We're thinking three-quarter point cuts, sometime between June and December is probably on the table at the moment, given just some of the slowing headline economic growth. And then there's a little bit of inflation risk on the horizon, which could slow the Fed down. That's the one thing that the Fed will be watching. In Q1, when we looked at consolidated inflation across all industries, all sectors. This is the most macro number you can get. It came in about 3.7%, and that's hotter than what we had last year, where it ran about 2.7. So we see inflation kind of going the wrong direction, and it's a lot higher than the Fed's 2% target. But there were a lot of anomalies in Q1 that we think maybe boosted it, maybe pushed it up. At the same time, we're seeing things like energy costs come down sharply. We're seeing other measures of inflation like food costs also coming down sharply. We're seeing some demand push a little bit of deflation in some of the commercial sectors. So you're starting to see it come down, and we'll look and see what the monthly reports that we get say as to what that inflation trend looks like. And the Fed will be watching it closely. But if everything stays kind of like it is or is trending where we think it will trend, again, those 3/4 point cuts are still on the table for this year. The other thing we're watching for longer term borrowing is the 10-year Treasury. And I've said this across all the videos that we've done this month. The 10-year Treasury is important when you think about mortgage rates or long term borrowing. So if the U.S. Treasury is correct, they think they can get the 10-year Treasury below 4% sometime by this summer, which would push mortgage rates below 6%. And if that happens, then a lot of families will go in, and that will kick in a refinancing trend. And a lot of families will suddenly see hundreds of dollars a month freed up for other discretionary types of spending. And we think that some of that will spill over into the RV industry. So that will be one factor that'll be positive. The other thing is that we're still getting really good job signals at the moment. So we don't see a surge in layoffs or unemployment. We do see that risk out there, but there's still about 7.4 million jobs open in the United States. 6 is normal. So with that 1.4 to 1.7 million job buffer in there, even some of the layoffs that are happening, like at the government level, a lot of those workers are starting to get absorbed into the job market. Many of them are taking early retirement. They were ready to retire anyway. Now they're retiring. That also helps the RV industry. So we're getting a lot of these signals, which are really positive. And then I know everyone is sitting back and saying, yeah, but what about tariffs? Okay, well, tariffs are a real risk. I mean, when you think about the Chinese tariff at 145%, there's a lot of materials, a lot of products. They go into the construction of an RV, they could get impacted by that. And we're going to have to watch the producer prices very carefully to look and see what that does to input costs in the RV sector. But a lot of them are being built in USMCA markets. So across Canada, the US, Mexico, and there's a lot of tariff waivers inside that market. So we don't know that the pressure will be that dramatic or that substantial overall. So once we start to get our first deals, we know what the structure of the deals will look like, and the chances of uh, tariffs being a significant impact on the industry long term is actually pretty low. So by July, we think we'll get a wave of these trade deal announcements. We also think we're going to get a tax bill signed. We think there could be some corporate tax easing, which could also help with commercial purchases of RVs. We think it helps the construction market, which also helps the RV rental market. So there's a lot of catalysts here that could be kicking in for the second half of the year. And that's what leads us to this. So when we look at GDP, top line growth, we know it's fairly flat in Q1. It actually contracted about 0.3%. We think after a couple of adjustments, maybe it comes up to around 0. For Q2, we're going to be growing just marginally, somewhere between maybe 0.5% and 1%. But then in the second half, we start to see acceleration. We start to see some growth. For the full year, we think we still come in at around 1.5%, and barring anything extraordinary, like a major spat with China and Chinese tariffs staying at 145% or coming down to 100% or something dramatic like that, we believe that recession is probably off the table. If we get any kind of recessionary pressure, it's just going to be by definition only, right? We're going to see 2 consecutive quarters of maybe some mild contraction, but from a business or corporate perspective, you're not really going to feel it that much. You're not going to see a sharp pullback in consumer spending like we did in 2008 or 2009. You're not going to see, what we saw during the lockdown period. It's going to feel more like a 2001 or 2001, 2002 type of recession where it was just moderate. We kind of blew through it. Most people didn't even know we were in recession. So it's kind of what we're looking at this year. Overall, should be a good environment. And again, there's a lot of volatility out there in the market. It could go any direction, and we'll continue to watch for that. But barring anything like that happening, the market looks pretty good for you for now. So hope everyone is doing well. Stay safe, and we'll see you next month. Right? Take care.